So uranium has hit that magic $60 per pound mark. Many investors, analysts and economists have been waiting to see this number hit because it's thought to be that incentive number that means that mines may start considering restarting around the world. Today we're going to talk about the broader uranium and nuclear discussion. There's a range of fascinating tailwinds that are beginning to converge. Of course, the macroeconomic landscape is one that is worth noting with everything that's playing out in Europe, the economic sanctions, and they do have implications for the uranium and nuclear market as well. And then we'll talk at the end about some interesting capital markets activity with some recent pieces of news flow from some of the leading ASX uranium companies. So stay tuned, strap in. It's quite an exciting time for the markets. We know that these are the highest levels that have been seen since 2011 and Fukushima. And as a result of that, there's a lot of eyes on the broader U sector now. And so to recap where we're up to in the uranium cycle, as we know, there was that significant run in the 2000s. Prices started coming down, and then Fukushima in 2011 really signaled the beginning of that winter for the broader uranium market. Prices came down significantly. As a result of that, it reached under the incentive price, and there was consequently not much investment into bringing supply online. Many mines went into care and maintenance or were mothballed and were put on hold until the price reached that incentive price, which, as mentioned, many believe sits in and around the $60 per pound mark. And so as a result of that, inventories began to be depleted over time. There was not much supply coming on. It's worth noting as well that for the context of the sector, there are a lot of long-dated contracts, and many of these contracts are starting to get to the end of this cycle, which is another factor that's contributing into everything that's playing out at the moment. So as mentioned, there was low levels of supply coming online. Inventories, as a result of that, began to begin depleting. We of course know that we're moving towards a decarbonised society. So alternative energy sources that can be carbon free but still provide baseload energy are being sought. And of course, uranium and nuclear is sought to be one of those solutions. It's been fascinating to see. Nuclear is becoming more and more into the discussion. We're seeing investment from a range of different nations around the world, including in China, including things that are playing out in the US too, which we'll talk about later in the video, including some of the European regions too. So it is quite a fascinating time, and I'd love to know your thoughts on it all. So drop in a comment below what you make of uranium at the $60 per pound mark, and where do you think things head from here moving forward? And so then moving on to the macroeconomic environment. We're all familiar with everything that's playing out in Europe at the moment. There's been a range of wide-reaching sanctions, and as a result of that, there have been implications on supply chains, as well as numerous commodity prices and energy prices around the world. As we know, there's been a higher demand for a range of alternative energy sources, and there's been a lot of eyes on nuclear as one of those, as the world looks to reduce their reliance on Russian energy. We've seen some recent moves that the European Union is looking to phase out coal imports from Russia as well, and all of this has been further catalysed, as we discussed, by this decarbonisation trend that we're really starting to pick up in awareness. Just recently, there was a bill that has now been introduced to potentially ban Russian nuclear fuel introduced in the United States. And all of this is further underlined by the focus of localization of supply chains and building out of supply chain resilience from many nations and regions around the world. This is not only isolated to energy. We've recently discussed how this is being seen in the EV battery materials sector and some of those other critical minerals. But of course, the energy sector has not been insulated from that, and they've been some of the contributing factors to this macroeconomic picture. And so then flowing through as well, I'm sure that many, particularly those who have been focused in watching the uranium and nuclear space over the past 12 months, are familiar with the name Sprott. We know that Sprott introduced SPUT, the Sprott Physical Uranium Trust, in 2021. They began buying up physical uranium, and there was a huge amount of attention and awareness on what that could mean for the broader sector. As a result of this, we know that there was already a tight supply market. As we mentioned earlier, not a lot of supply projects coming online over the past decade. And this meant that more physical uranium was begun to be taken out of market circulation. It's worth noting as well that Sprott obviously has a huge client base. They've got a range of different managed vehicles that they're able to offer to these client bases. Obviously, SPUT was one. But what's interesting now as well is they're recently finalising their approvals for the licensing rights to URNM. This is the uranium ETF that's offered by North Shore Global Uranium Mining ETF. And as a result of that, it's interesting because this will now fall under the umbrella of Sprott's funds. So Sprott will then be able to provide access to URNM on the equity side and SPUT as well for liquid exposure to physical uranium. And as we know, they're continuing to buy up, they're continuing to raise capital. And most of all, it's going to be really, really interesting because this is before the NYSE listing, which has been forecasted to potentially be in Q3 in 2022. There is a lot of things coming together. It's going to be fascinating to see where things head from here. It is also worth noting as well, as you guys know, the standard disclaimer, just a bloke on the internet who loves talking about the market. I'm obviously not a financial advisor. Nothing we discuss is financial advice. Hopefully, however, it is an interesting starting spot for you to go away and do your own research from. And so then that brings us to some of the recent news surrounding some of these ASX uranium companies. There's been a range of different capital markets activities, and so I thought we'd reflect on some of these different pieces of announcements. As we can see, one that attracted the market's attention recently was that DPLO, DYL and Vimy, VMY, have agreed to a merger by a scheme of arrangement. What's fascinating about this, as you can see at the bottom here, is that the merger is expected to create a new global uranium player with significant scale, cash resources, one of the largest uranium mineral resource inventories, and of course it brings together two advanced world-class assets as well as leadership teams. The merger is anticipated to be worth above $600 million, and so it's quite a significant scale. So it's going to be fascinating to see what plays out from there. Just having a look at some more of the insights surrounding this potential merger. It's bringing together two quality assets. When you have a look at combined annual production capacity, it's forecast to be above 6 million pounds, which of course is significant at scale, and you can see this in context compared to some of the other players listed on the ASX. There's geographical diversification as a result of this. A major mineral resource base of 389 million pounds, which is one of the largest in the world, and a combined portfolio of complementary uranium assets in tier 1 jurisdictions, both Australia and Namibia. And then just distilling down some more of the insights that came as part of this announcement. You can see here John Borshoff, the Managing Director and CEO of DPLO, who helped to lead Paladin Energy during the last bull run. He stated that this merger has the potential to be a significant value-creating opportunity for both sets of shareholders. The merger combines two world-class assets in tier 1 mining jurisdictions into a single group with scale and know-how. And so, along with that, the vision has been to deliver growth organically and inorganically to DPLO shareholders, and he's very pleased to state that they've been able to achieve that in this process. And then on the other side, the MD and CEO of Vimy stated the merger helps to de-risk and underpins a path to development at Mulga Rock, which is one of the largest undeveloped uranium resources in Australia, located in WA. They then have the combined financial, processing and operating strengths of both companies, which will enable greater optimization and the delivery of Mulga Rock, as well as establish exploration team for potential other projects, including Alligator River. And then bringing us to another piece of news which surrounded Paladin Energy, ASX PDN. First, before we discuss this, if you've enjoyed the video, don't forget to hit the like button. Feel free to share it out. We make a daily video each and every day, so if you haven't yet, make sure you've subscribed, turn your bell notifications on. We'd love to have you join the community. So having a look at Paladin's recent piece of news flow, they're raising over $200 million, and a lot of this is moving towards the restart of production at their flagship Heinrich project. As we can see here, the formal project launch is expected in July 2022, so the start of second half this year, and they're targeting commercial production in calendar year 2024. Of course, this speaks to the current state of the market that they're assessing, and they believe that they're poised to take advantage of the improving uranium market conditions and to be able to deliver sustainable value creation for all of the stakeholders. It's just interesting having a look at some of these recent pieces of news flow and the macroeconomic environment to get some insights into where these developers who are looking to bring their projects back online believe that the market's currently positioned. We'll have to wait to see where things head from here. Of course, the $60 per pound mark was a milestone that many analysts and economists had circled out on the calendars. So it's going to be fascinating to see what the rest of 2022 has in store for the broader sector. Let us know your thoughts. Drop in a comment below on it all. As mentioned, it's just a general discussion, but hopefully it is an interesting starting spot for you to go away and do your own research from. Thank you for joining us. For now, stay well and happy investing.